What a week we've got coming up for you. Live from New York City this morning. Good morning, good morning. Equities heading south. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
Live from New York City, we begin with the big issue, gearing up for earnings season.
We've got earnings season starting.
The huge earnings season coming up.
This whole question of earnings expectations.
Positioning and valuation is very bearish.
The economy is slowing.
The narrative between inflation and recession.
We're heading into, I think, a more earnings-constrained environment.
It's widely expected that earnings expectations are going to come down.
There's a lot of discussion about analysts cutting their estimates.
Company analysts are sitting there like deer in headlights, not knowing what to do with numbers.
We're not seeing that kind of analyst dispersion that is consistent with an earnings recession.
Listen, I think the earnings estimates out there are too high.
Rates are up. Investment sentiment is down.
There's a lot more pain to come for the consumer.
The real earnings hit will come in second half.
Joining us now to discuss is JPMorgan's Jack Caffrey, Winnie Cisar of CreditSights. And Winnie, first to you. On Friday on this program, Mohamed El-Erian said an avalanche of earnings revisions are coming. When does the bad news hit?
So I think the bad news is probably going to hit in the next couple of weeks, although I would note there are a number of companies who have tried to get ahead of bad news. If you recall, earlier in the year, we had a couple of the big retailers, some of the tech companies come out and say, hey, listen, 2Q and beyond looks a little bit worse than we were expecting. And so we've definitely seen a pretty significant revision lower. And at the just overall EPS level for S&P 500, the revision lower has been really quite material since the end of Q1. And so the big question is, have we re-racked enough? Or is that combination of top-line deceleration plus pricing pressure really going to weigh on margins and performance for Q2 earnings season?
Jack, given what you know now versus the start of the year in January, can you tell us how much your expectations for earnings have actually come down?
I think when we think about the earnings story, we have to really try to take it into three different pieces. We're going to have to think about how much is price, and that continues to be strong. How much is volume? I think that becomes the wild card question. As Winnie just mentioned, we've seen some retailers taking those numbers lower. And then we have to think about translation, because the S&P is not the U.S. economy. It's a global economy. And in particular, Europe is going to be both weak on price, on volume, and then on the translation of that back. And I do think that we are still perhaps too high. But in the world of Reg FD, we're going to have to wait for managements to help guide the street, to guide consensus, to give us a better sense of where that winds up, whether it's 1%, 3%, 5% too high. We'll hopefully get a much better detail on that over the next 2 to legitimately 4 weeks.
And right now, management is struggling to get visibility. Jack, I'd love your point on the dollar point just a little bit more. Let's get some more depth there, some more colour. Mike Wilson of Morgan Stanley over the weekend said this: the simple math on S&P 500 earnings from currency is that for every percentage point increase on a year-on-year basis, it's approximately a 0.5 times hit to EPS growth. It translates, in his calculation, into an 8% headwind for S&P EPS growth. Jack, how do you make a similar calculation? The moves we're seeing in the FX market, with euro dollar a clean break of 101 this morning, the dollar index heading towards 108. How do you make the translation from what's happening in the FX market to what you think will happen with earnings?
Well, I want to come back to the challenge with translation is it's noise not without a lot of signal, because it comes back and it doesn't really tell you what's going on with pricing in local markets. It doesn't come back and tell you what's happening to volumes in local markets. And that's why so many companies try to break down their top line, price, volume, and then translation. And it's going to be a big headwind. I think it's going to be a challenging headwind for U.S. companies with substantial European exposures. And that's going to be true necessarily, probably more in the older companies where they have more local exposure, probably in a bigger headwind actually than I think about and work through the math on the fly for some of those companies that have typically been dollar exporters, but you're going to get some flip side for some inflation relief because so many global commodities are priced in dollar terms, and those prices tend to actually weaken as the dollar strengthens. Where a week ago or 2 weeks ago, we're talking about weaker oil, weaker copper as reflective of a slowing economy. I think that there was a foreign exchange issue there, and then there's some concern that maybe we've got slowing demand as well.
Well, the foreign exchange issue is on the screen right now. Very briefly, 108 on DXY. Got to go back to 2002 for these kind of numbers. Right now, 107.99. The dollar stronger against pretty much everything. In fact, everything in G10. Winnie, on the same topic, how are you thinking about that issue going into earnings season?
So in the credit markets, the strength of the dollar has two big factors. First is just the earnings and international exposure, which Jack touched on a good bit. And what we found is that the U.S. investment grade market has much more of that global multinational exposure and is more exposed to the currency risk associated with a stronger dollar, especially when compared to the U.S. high yield market, which tends to be more domestic in nature. Now, another big factor for fixed income and corporate credit is the exchange rate, and the yield pickup on a currency adjusted basis that non-US investors can get for putting their money to work in the US markets is much less attractive when that dollar is stronger. And we have been waiting for other buyers to come into the US credit markets because clearly the retail investor is seeing really hefty portfolio losses and saying, I don't know that I really necessarily want to be involved here. Historically, those institutional non-US investors have come in to kind of step in and help mitigate some of that volatility and add some incremental demand. But the stronger dollar is a key headwind to that type of endeavor.
Equity futures this morning down about 0.6%. We're pushing forward towards earnings season. The unofficial start with JPMorgan, of course, on Thursday. Before we get there, CPI on Wednesday. We've got retail sales this week as well. And Mike McKee, a big focus, a renewed focus on you, Mitch, consumer inflation expectations. Mike McKee, I asked Citigroup a little bit earlier this morning where that ranked for them. They said that's the #2 data point of the week for them.
Go figure. It's like back to the days when Alan Greenspan would sit in his bathtub and come up with a new economic indicator. Now everybody has to pay attention to this University of Michigan number, which is kind of the last number released this week at 10 a.m. Eastern time on Friday. Ahead of that, though, a busy week. You could probably squeeze another day out in the Hamptons today. Not much going on unless you trade in the money markets. You want to hear John Williams' speech. But then Wednesday, we really pick it up with the CPI, and everybody's going to be watching to see if we hit another 40-year high. PPI and jobless claims on Thursday, and as you mentioned, retail sales and a couple of other indicators on Friday that will let us know where the economy is going. Now, the thing we want to do in looking at this is not look at those headline numbers. Yeah, everybody will say 40-year high in CPI. But what the Fed's going to be looking at is the month-over-month changes in these things, in the headline and in the core. In other words, are we slowing down? The forecast is we're plateauing. And if that's the case, then that's the direction the Fed wants to see things going. Retail sales, though, they would like to see rise. They were flat. The core rate, which leaves out the energy and food, it was kind of flat last month. And so if they can, if Americans are still spending, then that's good news. And then, of course, that Michigan number is the all-important number of the week. It's expected to go down. And if that's the case, Fed officials will be quite happy. We'll see what we're trading at the end of the week. But over the last couple of days, something interesting has happened. Markets have basically said, we agree with the Fed 75 in July, but now we're coming down to 50. You could see how expectations changed after the June meeting when they went 75. 2 days before, it went way up, the Fed funds futures. Now we're at a much lower level, and there's a feeling we might only get 50 in September if the numbers continue to improve. So check with us 10:01 maybe on Friday after that Michigan number is out.
Looking forward to it, Mike. It's got ridiculous, and I know you share a similar view. Mike McKee there from the Rocky Mountain Economic Summit in Idaho. We have to pay attention to what they're paying attention to, and apparently that's what they're paying attention to, and it was the difference last time around between a 50 basis point hike and a 75 basis point hike. To Mike's point, though, this has quickly become consensus, this view that we get 75 at the end of this month, and then we start to taper off. Goldman on board as well. They look for 75 in July, followed by 50 in September and 25 in November and December. Winnie, you're on board with this view that if we get 75 this month, that's the last 75 of this cycle. Why?
Well, for one, the Fed officials have stated that 75 is an outsized rate hike and really only merited when you're seeing very hefty inflation numbers. So if the June print is that kind of plateau on a monthly basis, especially when it comes to core and services, then the Fed has less air cover to continue to hike rates at really aggressive levels. Also, we had a very constructive June payrolls report, but whether we consider to continue to add jobs at the same kind of hefty clip is definitely a question mark heading into the back half of the year, which tends to be a little bit slower on the employment front anyway. So the combination of plateauing inflation plus the potential for some deceleration in employment and other economic data should keep the Fed on a little bit slower pace for rate hikes in the back half of the year.
So, Jack, push that through the equity market. The home builders say are down 30% this year. If I'm thinking about house prices, that particular industry group, the home builders, how are you playing that story now, Jack?
You know, I think that we've seen a shift away from the construction trade really to the renovation trade. You know, when we think about mortgage rates having basically doubled over the course of this year, when you think about the impact on affordability of higher prices even before you got to that, I think the consumer is going to be more likely staying in their home. I think, though, and that comes back to a lack of supply that we've really experienced going back to the global financial crisis with the peaking of housing activity in 2006. Embedding in that, I think there's some good news and bad news. I think the good news is that the consumer will continue to spend on their home, and it will more likely be smaller projects in where they currently are, but the spending continues. The more challenging news, I think, is by not actually adding to supply, you wind up continuing to keep pressure on rents, and rents wind up being that largest component, or I should say owner's equivalent rent, that largest component within the inflation number. So I do think that lack of supply winds up actually embedding somewhat pressure under core CPI for a longer period of time than the Fed would probably like. And I think that they were left between a rock and a hard place, wanting to slow down home price appreciation, but recognizing that the read-through winds up being a rental problem, and that matters, and that they don't really have a good way to solve that.
So, Jack, just to build up on the equity story, though, the kind of theme that you're trying to get behind should help the Home Depot-like company, shouldn't it? And Home Depot has not had a good year. Let's be clear about that. So can you be more detailed about what where you'd put the money?
I think it'd be fair to say that nothing that really has touched housing has had a good year. Whether it's the home improvement retailers, whether it's been the home builders, which have almost become a key pressure point when you've got stocks trading at 4 times earnings, 5 times earnings, trading at book value or 75% of book value, and book value is typically land value. So you're buying these things for the potential of literally dirt. The challenge, though, is that their orders are going to fall over the next year or two, and that most portfolio managers don't have the flexibility to look out for more than a year and able to say, well, 3 years from now, housing is going to be booming. And so in the short term, I think the builders themselves are more likely challenging money, if not, and at the same time, those names tied to home improvement retailers, some of the suppliers for kitchen cabinets, some of the paint suppliers actually wind up having a more interesting opportunity if they can push through price. They have been pushing through price. It's easier to repaint your kitchen than it is to build a new one. And more likely to make for domestic bliss if you can actually just make something a little bit better in the house that you're living in.
Yep. It's a good final point. Jack Caffrey's going to stick with us alongside Winnie, Cisar. Your equity market's down 0.7% on the S&P. A ton of single names we need to talk about. Let's get to Abby for more. Morning, Abby.
Good morning, John. And yeah, we have a bit of more cautious tone this morning after last week's rally, and a big piece of it, of course, the technology sector. That's the big weight to the markets. Right now, we do have Apple, one of the heavyweights, down about 0.7%, breaking a 5-day win streak. And even with yields lower, typically that would help out tech. Today, we, of course, have China influencing the technology sector with the new COVID flare-ups, lockdowns, plus new fines for China tech, really not setting a great tone, a bit of a bearish tone. That's true, too, for chip makers. NVIDIA down 1.5%. Chips overall down sharply. This company in particular receives nearly 30% of its revenue from China. So this new COVID news and the tech fine news not helping out NVIDIA. And then finally, let's get to the days, the weeks, the years. Big story stock. That, of course, John, is Twitter, down 5.5%. Of course, Elon Musk over the weekend walking away from his $44 billion bid. Big legal fight seems to be coming up. Or you have to wonder, is this a prelude to a lower price? Many, as you know, John, saying that he offered too much in the first place and had to do something to get the price lower. Let's see what happens.
Abby, thank you. Truist weighed in on this. If Twitter fails to bring this acquisition to completion, we would see the base case for the shares as trading in the high 20s, reflecting 25 to 30% further downside from current levels. Just a number to think about from them. Coming up, President Biden heading to the Middle East.
Gas prices, still way too high, have fallen now 25 days in a row. I'm not suggesting there's a lot more work to do, but I am suggesting we're making significant progress. The program is working.
That conversation up next.
I know times are tough. Prices are too high. Families are facing the cost of living crunch. But today's economic news confirms the fact that my economic plan is moving this country in a better direction. Gas prices, still way too high, have fallen now 25 days in a row. I'm not suggesting there's a lot more work to do, but I am suggesting we're making significant progress. The program is working.
President Biden touting the latest economic data ahead of his trip to the Middle East. The president defending his upcoming visit in the Washington Post op-ed, writing the following. This trip comes at a vital time for the region, and it will advance important American interests. The visit coming at a crucial time, with a recent New York Times poll showing 64% of Democratic voters preferring a new candidate for the 2024 presidential campaign. From D.C., Emily Wilkins of Bloomberg Government joins us now. Morning, Emily.
Good morning, John. I mean, one of the really interesting things about this op-ed, so many people equate Biden's trip to the Middle East with oil prices and gas prices, but that really wasn't something that the president focused on in his op-ed. He made the case that he needs to take the trip for diplomatic reasons, not only between the U.S. and Middle Eastern nations, but even among those nations, particularly Israel and its ties with other Arab countries. And so that's the reason that Biden and how Biden is trying to frame this, likely because he's not going to be able to walk away from this and see gas prices come down to by a significant amount for what Americans normally expect. And so he's reframing the trip as far as what his goals are. And yes, this is coming at a time where the president has really, number one, doesn't have the support for his own party when taking this trip. And number two, has really lost a lot of the support from the Democratic Party in general. I mean, really notable there that only 64% of Democratic voters polled by the New York Times say that Biden should not be their standard bearer in 2024. It'll be interesting to see how that really impacts what he is able to do with other nations abroad if they start seeing him as not going to be president for too much longer.
Emily, great work. As always, this president in a tough spot, and these are very complex issues. Emily Wilkins there down in Washington, D.C. Look at a little bit later. This is a must-watch. Guy Johnson, David Westin, sitting down with Commerce Secretary Gina Raimondo. They'll do that at about 11 Eastern time. A conversation on Bloomberg TV and on Bloomberg Radio you do not want to miss. Joining us now, Jack Caffrey, Winnie, Cisar, back with us. Jack, just on the energy story, big component of what's happening at the moment. Mohammed El-Erian on Friday said on this show that the most important issue for him as to whether he was going to be constructive or less so on risk assets was how sticky this inflation would be. Jack, how do you think about that very important point?
I think that the headline part, I think that's ultimately the crux of it. If we have moved from a period of sustained lowflation just to a period of sustained midflation, ultimately we have to reprice risk assets in terms of their valuations. And I think that's a two-part. One, future dollars are worth much less. And second, that you have to re-underwrite what your economic outlook and the stability of your economic outlook implies a higher risk premium. So coming through this idea of how sticky is sticky, how transitory is transitory, and how quickly you can normalize becomes a vital question that we have to work through. But that all said, it's hard to tease out some of that because so much of that, what we call high frequency data, like consumer spending, winds up being reported in nominal terms. And we've spent years talking about underspending depreciation. Well, in the world of higher inflation and maybe some more capital spending, do you actually start seeing cash flows get redirected back into the business, either in inventory in terms of your accounts receivable, or just good old capital spending to build plants closer to home?
Winnie, this is really important when it comes to fixed income. You've got to have a decent understanding of the run rate for inflation. And if we're going to come down to what kind of level? Rick Reeder of BlackRock, in a world of doom and gloom, and I've spoken to a lot of bearish people this morning, on Friday he was less bearish compared to where he was a few months ago. He said the following: if we're going to be seeing a run rate of inflation over the next 5 to 10 years a bit higher, maybe 3-ish, then right now you can buy high yield at 9 to 9.5%. You can buy investment grade quality in the front to medium part of the curve at 5%-ish. He said that's a pretty good real rate. He's not piling in from his cash position, just slowly starting to make that move. Winnie, I just wonder how you're thinking about that.
I agree with Rick on that point. We've become much more constructive on corporate credit over the course of the year, especially longer duration asset classes like U.S. investment grade. Yields there are now at levels that we haven't seen on a sustained basis really since before the great financial crisis. And so if we're in a more moderate inflation regime, a long-term allocation to fixed income feels much more constructive now than it clearly did at the start of the year when yields were very, very low. Similarly, in U.S. high yield, we're now trading at a level that implies a lot of credit risk in that asset class. And the reality is corporate fundamentals are in much better shape to contend with some sort of deceleration, slower top line, continued pricing pressures than in any other credit cycle. And you have a much more fundamentally sound investment opportunity combined with very attractive valuations on a longer term basis.
That's about as constructive as it gets at the moment, at least. Winnie, Cisar there, Jack Caffrey on the latest, looking ahead to earnings season and the data this week. To the both of you, thank you. Coming up, the morning calls, and later, UBS's Stuart Kaiser joining us at the opening bell, looking ahead to big bank results and Wall Street squaring off over earnings season. Why Stuart doesn't think it's going to be that bad. That conversation up shortly. 5 minutes away from the opening bell. Equities negative 0.6% on the S&P. That's the price action. Here are your morning calls. First up, Needham downgrading Meta Platforms to underperform amid rising competition and regulatory headwinds. Jefferies with a street low $10 price target on Under Armour, citing concerns over top-line growth and weakening margins. And finally, SocGen upgrading Bank of America to a buy, saying that shares remain compelling even in a recession, given the bank's defensive loan portfolio. That stock's down 0.4%. Coming up, the big banks gearing up for earnings season. UBS's Stuart Kaiser saying market expectations look too bearish. He's joining us next. Your opening bell just around the corner. 25 seconds out from the opening bell this morning. Good morning to you. Here's the equity price action, down about 0.7% on the S&P. On the Nasdaq 100, down 0.8%. A little bit softer lower, down by 0.75% on the Russell, off the back of a really decent week of gains on the Nasdaq last week, up around 4.5%. There's your opening bell. Switch on the board and get to the FX market. Never mind the bond market. What a move we're seeing on euro dollar. Clean break of 101. 100.64, down by more than 1%. Weaker euro, stronger dollar against everything else. The dollar index is so much stronger this morning. We are through 108, and we're seeing levels we haven't seen since October 2002. In the bond market, yields come lower by 6 basis points, 3.0188% on a 10-year. And with that stronger dollar, you're seeing something we haven't seen much of over the last year. That's crude trading lower again by 1.5%, 103.24. That's the price action. Let's get you some movers. Here's Abby.
John, well, one of the worst sectors on the day right here, at least at the open. Technology really down in a big way after a big week last week, as you mentioned, and underperforming the chip sector, down 1.6% overall. AMD, a piece of it, down 2.1%, and that tone out of China, a piece of this action, of course, with a resurgence in COVIDs, new lockdowns, fines for some of the big tech. 25% of this company's revenue comes from China, so we can see AMD down 2%. Coinbase Global down more, down 4.9%, of course, as Bitcoin struggles to find any sort of support. This, of course, one of the large crypto exchanges, shares lower. Las Vegas Sand down 3.9% on those China lockdowns, that resurgence of COVID in Shanghai down 4.1%. 68% of Las Vegas Sands revenue comes from Macau. And then finally, Tesla trying to find firm footing after last week's 10% rally, right now up slightly. This, of course, is the $44 billion Twitter bid is off by Elon Musk. Some investors think that could be good news for Tesla. So much more to come with this story, though, so let's keep an eye on Tesla.
Abby, thank you. A minute and 40 seconds in, we're lower by 0.6% on the S&P. The only industry group I've got in positive territory, the staples, up by a little more than 0.1%. So far this morning, to kick off the trading week, everyone I've spoken to, I'd say 90% of them, so bearish. We caught up with Sono Desai of Templeton, Franklin Templeton, this morning. She said we're pricing in rate cuts next year way too soon. It's too early to buy risk assets. Wei Li of BlackRock, caught up with her. She said the Goldilocks outcome is off the table, downgraded developed market equities even further. Michael Shaul of Marketfield said we could face what he considers to be a market accident, and if you want to look for one, look to Europe. So there you go. Looking at Europe right now, clean break of 101 on euro dollar, clean break of 108 on the dollar index. Dollar index seeing levels we haven't seen since 2002. We'll come back to the cross-asset price action in just a moment. On single names, it's all about Twitter, down about 6% in early trading. Shares taking another leg lower through this morning with Elon Musk and his reversal, sending him to face the courts in Delaware. Bloomberg's Ed Ludlow joins us now for more. Morning, Ed.
Yeah, good morning, John. It's good to see you. According to sources, a court filing could come from Twitter as soon as this week. Brett Taylor, the company's chairman, tweeted on Friday following that announcement that they would take legal action against Elon Musk. Elon Musk terminating the merger agreement because he said that Twitter was not forthcoming with its information about the level of bots on the platform. And if you read through the dense letter that Elon Musk sent to Twitter, he basically points out that on multiple occasions over the last 6 weeks, he asked for information that Twitter did not give to him. He also said that, frankly, the fundamentals of the business had changed in that time. What's interesting is over the weekend, sources in the room at Sun Valley told me that Elon Musk resisted the urge to comment on the deal. He made a general comment that Twitter needs to be more transparent with data and its algorithms, but declined to respond to a question on the deal. Then he tweets over the weekend, I'm not going to read all of it, a meme with pictures of himself making the point that he asked for information on bots, which Twitter didn't give. Twitter are likely to take him to court, and according to this meme from Musk, they're going to have to hand over that data on the bots anyway. Twitter has hired merger heavyweight law firm Watchell Lipton, Rosen & Katz to fight this, according to sources. And if you look at past precedent and you look at what the market's saying, Twitter has at least a 50% chance that they could be successful in holding Elon Musk, the original deal, $54.20 a share that they agreed in April.
So, Ed, I'll let the lawyers deal with the legal stuff. I'll let the entertainment channels follow the Twitter account. You tell me how Twitter is going to be run as a company over the next few months as they work through this mess.
Yeah, John, I just pushed the audience to go onto the Bloomberg terminal and read our reporting from the weekend. Friday night, an internal memo went out, according to sources, telling Twitter staff, do not tweet about this, pending legal action. Do not talk to the press about this, pending legal action. Sources at all levels of the company tell me they've basically lost faith in leadership, that they feel like Parag Agrawal has been on the defense this whole time, and that there's just nothing happened. The company's in stalemate, right? And a lot of people at Twitter had decided to leave anyway after that Musk all hands a couple of weeks ago because they felt whatever the outcome of this scenario with the deal, the company is basically directionless at this moment in time.
But if you wanted to catch up with someone and talk to someone, you can speak to Ed Ludlow. Ed's all ears. Ed, thank you very much, buddy, as always on the latest. I talked about Truist a little bit earlier in the show. Let's go back to that quote from them as the stock trades at about 34 this morning, down 5 or 6 percentage points. They said if Twitter fails to bring this acquisition to completion, and it looks like it's heading in that direction, we would see the base case for the shares as trading in the high 20s. That's their view. 34. Do you remember 54.20? That feels like a lifetime ago, the agreed price. We look ahead. We'll put Twitter to one side. We look ahead to the banks. JPMorgan kicking things off this Thursday. It is the unofficial start of earnings season, and Katie Lines, it's coming up very soon.
Yep, just a couple days to go until JPMorgan kicks this off, John. And collectively, the financials are expected to see profits fall 23%, the biggest drop of any sector within the S&P 500. But of course, beneath the headline figures, there's going to be a number of signals we're looking for from these banks. On the one hand, trading revenue, but more importantly, perhaps investment banking revenue, given how we've seen a slowdown in M&A and IPO activity. And then, of course, you have the net interest income story. In theory, that should be getting a boost from higher interest rates. But with those borrowing costs moving up, what is happening with loan growth and mortgages? We're going to look for those answers. And then on the conference call, a lot of the color investors will be looking for is from the executives, the likes of Jamie Dimon. What is his take on the health of the consumer and the economy overall? What kind of odds are they putting around a recession? And of course, it is recession concerns that have weighed heavily on the banks this year. JPMorgan, Bank of America, Citi, all down at least 23%. Collectively, the KBW Bank Index is down by about that much, underperforming the broader market with the S&P down 18% this year. And of course, the reason the S&P is down and stocks as a whole have been hit is a laundry list of concerns, a recession among them, which is why investors are hoping that some of these corporate results may give us some clues as to how companies are hanging in there. Are they able to pass on higher costs, hold up margins, or are they going to take a more cautionary stance? And what's interesting, John, and what we were just showing there is even as clearly sentiment has turned sour on the part of investors with stocks selling off, analyst estimates are hanging in there. So someone's going to be right, John.
Kelly Lyons, and someone's going to be wrong. Kelly, thank you very much. Can we look at the FX market right now? We're seeing things we haven't seen since 2002, and euro dollar is breaking down again. 100.57. You can see it on the screen. We're negative more than 1%. Session lows down by 1.3%. This ahead of the ECB meeting on July 21. And on July 21st, we'll see something potentially we haven't seen for a long, long time, going back more than 10 years, a rate hike from the ECB. But this ECB is stuck between a rock and a hard place. We caught up with Deutsche Bank and George Saravelos earlier this morning. I asked them a very simple question. A rate hike from the ECB, currency positive or currency negative? And in this world, for this ECB, they can't answer that question. And that's the problem in the FX market. The problem for the ECB is the more weakness you get in the currency, the more problematic the energy story becomes. And if you can't forecast the price of gas in Europe, how on earth do you forecast the single currency? What on earth should you do as a monetary policy maker and official there? Tremendously difficult stuff. And part of the reason, Kit Dukes of SocGen said last week, and he said repeatedly over the last few weeks, the last month, that currency for him might be unbuyable. Euro dollar 100.55 and getting closer and closer to parity. We'll stay on top of that story. Guy Johnson will pick it up in about 20 minutes' time. We're looking ahead to earnings season. Stuart Kaiser of UBS says the following. Expect a high single digits beat of consensus EPS, but mostly driven by revenues. We expect large 2 to 3% sales beats to drive over 7% EPS beats in the second quarter. Stuart joins us now. Now, Stuart, I can find many, many bears out there on earnings. I can find a lot of people who think those revisions need to happen, those earnings estimates need to come down. You're not one of them, Stu. Tell me why.
Hey, good morning, Jonathan. Look, I think there's clearly a downside risk to earnings, but I think, from clients we've spoken to, you have forward EPS at $230 approximately for the S&P 500, and we think getting that number down to call it 200, which feels like the base case that's around the street right now, it's a pretty heavy lift in a positive nominal growth environment, because I think what you really need to have in that scenario is almost a hard landing type outcome early next year, because that is a 4-quarter, forward earnings number. So to knock, $30 off it, or about 15%, we do think you need a pretty significant kind of negative nominal growth shock in your outlook, which is not our base case right now.
So, Stuart, given the arc of earnings and how earnings come in through earnings season, you know how this works. The banks come first, then you get tech, then you get retail further down the line. How would you be playing this story through earnings season?
It's a good question. I think expectations are, fairly low for the start of earnings season. I think, as Kayleigh mentioned, a lot of headwinds on capital market activity for banks. I think the outlook, for companies like Apple and Amazon and Tesla has been pretty significantly derated. Our analysts actually have a fairly positive tactical view on earnings for a lot of those large cap stocks. So we do think there's an opportunity here for a little bit of a relief rally. I think, to your point, later in the season, when you get into those consumer sectors, could be potentially when the season gets very, very interesting. That's what happened last season, right? You had a couple of these, Walmart and Target and some stocks in the consumer staples sector really showed the negative impact of inflation and inventory. So it could be that we need to wait a few weeks into earnings to get to the real meat of the information.
Things are pretty negative right now. 10, 11 minutes into the session, we're down about 1% on the S&P. On the Nasdaq, we're down 2. Stuart, last week, big rally for the Nasdaq 100, up more than 4.5%. Just lifting the lid on the things that you track, how did investors use that rally? Was that people just reloading with downside protection? What are they doing?
It's a good question. We haven't seen a whole lot of conviction in either direction recently, Jonathan. I think, if you think from an S&P perspective, I think a lot of macro guys were trading kind of a 3,800 to 4,200 range. And when we broke below the lower end of that, it kind of kind of took that strategy with it. So I think there's a generalized lack of conviction. Last week ahead of the payrolls report, you weren't going to go to a lot of folks taking risk. And frankly, I think ahead of earnings now, it's going to be a wait and see and kind of dip your toe in. So I think, frankly, we saw a fair amount of short covering last week, more so than we saw new capital being put to work. And until we, really get some earnings results, I think the appetite to put your risk on is pretty low. So you're going to have these low volume trading markets with a lot of short covering and then reinitiating hedges after a small rally, and you just sort of get trapped, unfortunately.
And a ton of vol coming out of the bond market. Stuart, I just wonder what that means on the equity side. I've been tracking fixed income. You've been following it too. Last week, Treasury yields higher by more than 20 basis points. The week before, lower by 20 basis points. And the volatility, Franklin Templeton came on the programme with us earlier this morning and said the volatility is not going anywhere. It's here to stay. Stuart, for someone looking for that NASDAQ trade to work, do you need that volatility in the bond market to die down?
I think you do, and for sure, bond volatility has, I think, been a key indicator or metric for equity risk sentiment, throughout the first half of the year. I think the question is, can you get it lower, and for how long? Because you might argue that both FX and bond volatility were held artificially lower by policy over the last couple of years, and maybe really what we're seeing now is both a removal of that policy, but also, frankly, a move back to what would have been historically normal, given the type of macro data volatility we're seeing. So I think, some of this is clearly policy driven, i.e., the Fed tightening. And part of it, I think, is, frankly, you're just not suppressing that volatility as aggressively as you used to. So bond volatility is going to come in, but I think if you're expecting it to get back to where it was, the last couple of years, you're probably going to be disappointed.
Stuart, we touched on the relationship or the potential relationship between fixed income and, say, the NASDAQ. Can you tell me about the relationship between fixed income rates and, say, the banks as they report earnings this week? They struggle at zero rates, we know that, but they haven't benefited from higher interest rates either. How do you think that story is going to develop in the coming quarters?
Yeah, I think it's a great point. I would put utilities and banks both in that similar category, i.e., rates were rising, utilities managed to outperform in a way they normally wouldn't in a rate rising environment. Banks have underperformed in a rate rising environment, which typically you'd think would be good for net interest income and their profitability. And I think the thing that ties those two things together is recession risk. And, to the extent that these banks are talking about, material growth slowdowns, slowdown in consumer spending, increase in credit reserves and things of that nature, then frankly, bank equities are not going to be able to keep up with the move in rates. I think if we start to get those recession odds a bit lower and we see kind of some resilience in consumer spending and things of that nature, then I think that opens up a window for banks to perform pretty well as they kind of catch up to the move we've seen in rates. But right now, I think it's that recession risk that's holding banks back, and it's going to be really interesting to see how the large money center banks discuss the rate of consumer spending and domestic economic growth.
They can't get a break. Yields down this morning, banks down this morning. When yields are up, I'm not sure they're going to be up either. Stuart, just final question. Your favorite trade right now, what is it?
I think it depends on the direction, Jonathan. For hedging, we like hedging in small cap, and that's a pretty high conviction view. If you look at how implied volatility in small caps is priced right now, it's less than 2 times the implied volatility in high yield credit. It was more than 5 times that high yield credit volatility late last year. So I think what you've seen is the growth risk that's been priced into credit markets has not been adequately priced in small cap equities. So if you're worried about recession, we would be hedging in small cap. To the upside, our view hasn't changed. We still like some relief on the tech story. If you look at where inflation break-evens are, they're actually net down year to date. And I think if we do get some reduction in bond volatility, you can get large cap tech to respond positively, particularly given low expectations. And then banks, I think, are another area. If we can start to get bond vol down and maybe worry a little bit less about recession, I think there's a trade there as well. So I think you're hedging a small cap, and then you're looking at tech or potentially banks to the upside.
Stuart Kaiser of UBS. Stu, great to catch up, sir. As always, equities down by more than 1% on the S&P 500. The NASDAQ down by about 2 full percentage points. Coming up, the administration preparing to make a decision on China tariffs.
The president is being thoughtful about this. Unlike President Trump, those tariffs that he imposed made no sense. And so we are briefing him, and I expect to make a decision shortly.
That conversation still ahead.
The president is being thoughtful about this. Unlike President Trump, those tariffs that he imposed made no sense. And so we are briefing him, and I expect to make a decision shortly. And if he decides to lift certain tariffs, it will be because he knows he has to think about doing everything he possibly can to provide any relief to consumers.
He's the Commerce Secretary, Gina Raimondo, there catching up with NBC over the weekend. Do not miss this. Guy Johnson, David Weston speaking with the Commerce Secretary at 11 a.m. Eastern Time. An exclusive conversation today on Bloomberg TV and on Bloomberg Radio. One you don't want to miss. Bit of breaking news. A Bloomberg Scoop. Let's get to Abby for a little bit more. Hey, Abby.
Hey, John. Well, breaking news indeed. Morgan Stanley is changing things at the top of the bank. They have tapped 2 veteran deal makers to run their investment banking operation. Eli Gross, a 24-year veteran of the company. He has helped lead the transportation infrastructure banking practice in the past. And Simon Smith, also a 24-year veteran atop of the investment banking operations in Europe. They are now running the global investment banking division. This is according to a memo to staff on Monday, seen by Bloomberg News, replacing Susie Huang and Mark Eichhorn. What makes this so interesting, John, of course, this year has been very difficult for banking. Mergers and acquisitions in particular, global merger volume dropped about 17%. So you have to wonder if this change is to try to help the bank gain some ground in this challenging environment. The stock down, interestingly, on this, about 1.8% ahead of the headline, down about 0.8%. Let's see how it all shakes out. But again, Morgan Stanley has tapped 2 veteran deal makers to now run their investment banking operation.
A lot of the banks a bit softer this morning going into earnings. Abby, thank you. That stock 75.36. Morgan Stanley reporting earnings on Thursday alongside JPMorgan as well. A lot to talk about on that front. We will be catching up, of course, with the lady herself, our Washington Wall Street correspondent, rather, Shnali Basak, a little bit later this week. Equities down by 1.26% on the S&P 500. On the Nasdaq, we're down by a little more than 2%. The story in Asia was a struggle today, and the focus very much on these new COVID infections in China, infections in Shanghai climbing, and bringing back the potential of further restrictions. Taylor Riggs has more. Hey, Taylor.
Yeah, John, and certainly, pretty concerning in this world of a zero COVID policy. So the time of where you're getting a little bit of some new cases, this new BA.5 variant, of course, normally maybe not sort of a huge sign as we're learning to live with this virus. But of course, over in Shanghai, it is such a different story, right? 69 new infections, mass testing again this week. And remember, we just came out of a 2-month lockdown in June. So that's sort of the concern as we start to open up. How does sort of all of these new variants come into play? Change up the board. It's interesting when you think about the contribution to GDP. Of course, you and I know Shanghai, sort of a big financial center of China, actually still only the 10th in terms of the largest contributor to GDP. So it's a little bit concerning, but maybe more concerning if it starts to spread to some of the more important economic regions as well, not just a main financial hub. If you can see, though, on the terminal chart, overall COVID infections, hugely down from where we were just a few months ago, but starting to rise just a little bit. Again, not a big deal, except for when we're living in this COVID zero world. That's the issue here, John.
Taylor, thanks for being with us. Looking forward to the close a little bit later alongside Romaine Bostick and Caroline Hyde. No doubt that we're picking up on this story with some big moves on the likes of Alibaba. Abby, they're getting hammered.
They are getting hammered. That Nasdaq Golden Dragon Index overall, John, down about 7%. Its worst day in more than 2 months on that COVID story that Taylor was just talking about. Plus, you have Alibaba and Tencent both having fresh fines from the government. So that uninvestability story coming back into play for China tech. That said, it is up in a big way this year, up over 50%. Interestingly, though, a 1-year chart, you can barely see it because the declines into this year's gain very small. Only inflows this year, John, but today a big breather.
Abby, thank you. Those stocks are suffering. Coming up, your trading diary. There is a ton to look ahead to. From New York City this morning, good morning. 25 minutes in, risk aversion right across the board. We're down 1% on the S&P, down more than 2% on the Nasdaq. Yields take a leg lower, down by 9 or 10 basis points, and the dollar rallying really hard. That's the cross-asset price action. Here's your trading diary. President Biden speaks at 11 Eastern. A host of Fed speak through the week. Barkin, Bostic, Bullard, Williams, all on deck. CPI Wednesday. Then the president heading to the Middle East. The big banks kicking off earnings on Thursday. JPMorgan and Morgan Stanley on deck. US PPI, another round of jobless claims. claims, retail sales, and you, Mitch, all in the mix. From New York City this morning, good morning. This was the countdown to the open. This is Bloomberg.